Welcome back. You're watching the 80 Money Show with me, Kavita Thuplial, and now we'll talk about innovative investment themes and what does it mean and how can you go about it. For all of this, I have Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth Management. Feroz, good evening. Welcome to the show. And we all know that investing as per innovative theme or the kind of themes which are launched by AMCs, only in experienced investor should be trying their hands in it. But when I talk about innovative themes, what does it actually mean? What kind of investment strategies or what kind of investment routes are we talking about?
See, Kavita, when we speak of innovation, the canvas is very large.
Right.
But I personally believe in optimal innovation. So you don't innovate too much that you're experimenting with your money or you're going far beyond your risk appetite, irrespective of your experience in the capital markets. Point one. So optimal innovation. What all can people do with their monies? They can try out unlisted shares. They can try out InvITs and REITs. They can try out global investing. All those are innovative. But I personally think in the mutual fund category itself, some degree of innovation is good enough to give that little flavor to the portfolio which seasoned investors can adopt as the first step. If you're going to innovate, you have to start with baby steps. And I personally think the most efficient platform for innovation itself is mutual funds. But people go sometimes invest in angel funds, they invest in private equity, they invest in venture funds and lock in their monies in innovative, attractive looking themes. People also invest in art funds and they've actually burned their fingers. So when I'm speaking of innovation today, I'm just restricting it to a very conceptually very strong platform, which is mutual funds.
When we talk about mutual funds, what themes and what innovative themes are we talking about? In last 1.5 years, we've seen a lot of interesting launches happening in different sectors with different themes. So what exactly do we mean by innovative themes in mutual funds?
See, there are several, like you said,
Right.
sector funds, global funds. Today we have silver ETF. We have dividend yield funds. We have focused funds. I personally think focused funds and dividend yield funds are very contemporary. They are innovative because they are not conventional categories. Large portions of the assets are in large cap, mid cap, small cap categories. In the total 21 odd lakh crores of equity mutual fund, a substantive portion is taken by these conventional categories. For example, focused funds, where there is a quasi PMS kind of an approach, portfolio management service kind of an approach, where the fund is only going to buy anything less than 30 stocks at a point in time. Is a focused fund, as the name suggests, has an attribute of high conviction fund manager ideas. The propensity to beat Nifty and marginal more risk is very high here relative to the other conventional themes. Since it's the mutual fund platform, it is affordable by most investors. Of course, seasoned investors should choose this category. Dividend yield, I think, is an innovative theme. In current market situation, cash is something which makes the stock very resilient. So dividend yield kind of a portfolio which is created on the basis of the stock paying out dividends will have risk mitigated and still have in the times of uncertainty a stable component which will innovate to give you a little extra return with reduced risks. So these are the two themes which I can elaborate further if you so choose.
Feroz, when can an investor know that it's the right time to add this color of innovation on their portfolio? When can one diversify in this area?
See, I personally think if the innovative themes are chosen looking at top-down macro situations, today you are looking at huge uncertainties, right? So an innovative theme which is not so new, but it's unconventional for most portfolios don't have a dividend yield product in their portfolio. Dividend yield is a contemporary theme. So to answer your pointed question, when does one know that he is prepared for innovation? If the innovation is marginal, it is not it's not very extravagant or flamboyant. You are ready for it even after 1, 2, 3 years of investing experience. Now that's point one. So if you have a 3-year investing experience in mutual funds, you're qualified to buy a dividend yield fund because your comprehension capability, or having invested for 3 years, is good enough to understand that dividend yield products will buy stocks or the fund manager will buy stocks in the portfolio which are higher on dividend yield. There are several stocks which might not have run up because they are a more lethargic group from a capital gain perspective, but from a dividend perspective, they stand out. So that's an innovative theme. So 3 year plus investing career is good enough as a benchmark for you to go beyond the conventional.
These kind of themes and investment strategies have high tax impact. Could you elaborate on this?
Kavita ji, since we narrowed down our innovation to restrict it to mutual funds currently,
Right. Yeah.
their tax is identical to the rest of the mutual funds, fortunately. But like you said, other innovative platforms, like if somebody wanted to buy an unlisted share, the taxation there could range at 20% as against 10% in the listed space. If you're doing, for example, a REIT product, which is nothing but a product where residential commercial property is bought, the income you get is going to be marginal tax rate. So since innovation in our conversation for the current limited purpose is restricted to mutual fund, taxation is going to be 10%. Unlike most innovative themes, generally have a tax detriment by being a 20-30% slab as against 10, unlike equity mutual funds.
Exactly. So now cherry picking direct stocks or bonds for an investor may not be easy, but then yeah, if you want to go for innovation, you can really try this out through mutual funds. Feroz, this was about the seasoned investors that we spoke about, topic very relevant to them. But then now let's move on to our queries where we have all type of queries. First one coming up is from Nilesh Rawat, and he says that he's 30 years old and he's earning almost 80,000 monthly. He's been investing 5,000 in each fund since 2020, and now he wants to buy a house worth 1.5 crores in next few years, and he wants to know as to how much should he invest. The schemes are SBI Blue Chip Fund, SBI Hybrid, Quant Blue Chip Fund. These are the three funds that we are talking about, and uh, uh, how 5,000 in each fund. That means 15,000 SIP going on right now. How much should he be increasing his investment amount, and your take on the funds first?
You see, firstly, every one of us should check whether you're at least saving 30% of your salary as your investment. So, from an 80,000 standpoint, I personally think that he should try and do an SIP of 24,000 to be as a pass mark in terms of the saving ratio. I know it's easier said than done. It's very difficult. If you're living in a metro, we know the kind of price rise, inflation we see. But you should try and stretch towards at least saving 20, 25, 25 to 30% of your total salary in the form of investing, especially during the first, like if you're earning less than 1 lakh, India has one of the best tax regimes because you have taxation not more than 10-12% on your overall salary if you use the method 2 of direct tax, which was introduced a couple of years back. So point 1, increase it to at least 25% as the first step. You are at 20%, move that to 25%. That's 20,000 rupee SIP is a healthy number to save. Point 1. Point 2, now let's look at your portfolio where you have 3 schemes. 2 of them are SBI. It makes no logical prudence to have two-thirds of your savings with one asset management company. When you have several asset management companies, you should create a portfolio of 4-5 different asset management companies managing your savings. Because if you're going to be saving with great difficulty, you don't want two-thirds with one AMC and another. So you have one of the largest AMC and you have one small AMC quant. So the strategy has to be well diversified across asset management companies and schemes. So I would recommend to you to exit 2 SBI schemes and add 4 schemes to your portfolio. HDFC Flexi Cap, Kotak Emerging Equities, Franklin India Blue Chip, and SBI Contra. These 4 schemes from 4 different categories, 4 different AMCs will reduce your exposure to SBI to 2-3,000 out of your 15,000. That's recommendation 2. Now, if you want to accumulate 1.5 crores for a home, fortunately, when you buy a home, you are entitled to a reasonable portion in the form of loan. So you have to prepare to collect money for the down payment because home loans are the cheapest loans which an individual can borrow. The borrowing rates are as much as the borrowing rate of Government of India, practically, right? 8% home loan rate. Government of India borrows at 10 years at 7.5%. So So try and accumulate only the corpus of your down payment of the house and not the full amount. Then it will be very practical so that you can focus on your other goals of retirement as well.
Since we're talking about buying a house, and he says that within a few years he wants to get this gold strike off from his list, the current amount that he's considering is 1.5 crores. Do you think he really needs to calculate or reevaluate this particular amount? How can he go about it if there's a time of say like 5 to 7 years, when he's actually going to buy?
Yes, Kavita, like you said, the house may not remain at 1.5 crores. In 10 years, it might probably become 2.5 crores. In our experience, residential property, we have analyzed several properties. The growth rate over long periods of time of residential property has not ranged anywhere greater than 6 to 8%. That's the current status of metro cities, at least. Like if you look at Mumbai, Bangalore, Hyderabad, and look at properties, residential properties, top 50 properties of each city, the kind of appreciation over the last decade they've seen is anywhere between 4 to 6, 7%. So you should provision for the double the amount if it's 10 years away. That's what 7% inflation actually implies. If I need 1.5 crore today, and after 10 years, if I have to buy the house, and if the house appreciated at the rate of 7%, you will need 3 crores. Simple math, 7% in 10 years doubles the money. If it's 10 years away, you should at least provision for twice the amount, and not the full amount, but the down payment for it, which could be 10 to 15%, which is 30 lakhs to 45 lakhs is what you should save for it. And in the 10-year period, I'm sure, Nilesh, you're just 30 years old. At the age of 40, your disposable incomes would have gone up because you're at the fact beginning. You're in the beginning of a career, I'm sure. And it progresses beautifully between 30 and 40. So I'm very hopeful that you will be able to meet your objective. But take Kavita's point to provision for a price rise in your property.
All right, we move on, and next query is from Anil D'Souza. He says that he is 35 years old and 1.5 lakh is what is he earning monthly. So far, no investments, but he has some amount in savings and fixed deposit. Now he wants to plan for his retirement, and he wants to retire by 60, and 9 lakh in FD so far that he's calculated. Very interesting question. Unfortunately, I don't have him over the phone line. Otherwise, we could have really asked for more details, Firoz. But then, how can he go about it? And it's good in a way that he's realized that investing in a savings bank account or fixed deposit won't actually earn him anything. So, how can he begin his journey?
Yes, so good, better late than never, Neil.
Yeah.
At the age of 35, you realize that equity is one of the few asset classes which will help you beat inflation. When the world is speaking about inflation, you can't have an instrument which is surely going to lose to inflation at least after tax, right? So you say that you don't have any liability. To my mind, your FD itself is a liability. Because if you just did a mathematics of, if not for the FD, if you saved it in a conventional long period mutual fund which has 20, 20, 30 year track record, you would be sitting at 20 lakhs as against 9 lakhs. You should do this math, and then you know what's the kind of opportunity loss this comfort would have brought you. Of course, buying an FD keeps you very safe, keeps you very comfortable, but that comfort comes at a cost of not having turned this money into 20 lakhs approximately. You should do that math. If you didn't buy an FD on that particular day, bought probably an HDFC FlexiCap one which has been there from 93, what would have been your value? Then you will know what was the cost of this comfort which you bought yourself in the form of an FD. Point one. Point two, even if you don't want to buy equity, you shouldn't have been in an FD because you're in the highest tax bracket. 1.5 lakhs per month implies 18 lakh rupees. That means you're in the highest tax bracket. Even if you bought a debt fund, which was an index debt fund, you would at least make a 10% FD equivalent on the post-tax basis. So you're losing money because you're on the highest tax bracket. You can lend the money to Government of India through a IDFC Nifty 2027 index fund and make 6% post-tax approximately. Right, and here you would be making 6.5% pre-tax. So that's point two. Point three, at least make sure that going forward at the age of 35, if you don't have equity, it's a short way of not retiring rich. FDs can never retire you rich. You will always be hand to mouth because inflation will catch up with your price rise. So point is, I'll give you five funds which you can begin with. Franklin India Blue Chip, HDFC Flexi Cap, Kotak Emerging Equity, SBI Contra, and ICICI Focused Equity. If you buy these five funds, you have 130 stocks in your portfolio. Not all of them would go down. Not all of them will go up together. You have 130 different companies working for you. How can that not result in a value greater than FD if you can hold it for 10-year periods?
All right, we move on to our next query, Rutu Parab. And Rutu is 22 years old and is a salaried person, earns around 30,000 per month, out of which 50% goes into monthly expenses, including rent. And Rutu has just started saving 5,000 per month, and this goes into PPF. Currently, no loans, no financial liabilities ahead, but then wants to invest in mutual funds and wants to know how can Ritu manage the finances in hand.
Yes, Kavita, we have several first-time investors as
Exactly.
scholars. It's so beautiful to see.
Right.
Right. India is waking up to the opportunity of India.
Totally.
That's great. And Rutu, assuming she's a lady, it's even more pleasuresome at the age of 22, seeing a young bright girl wanting to invest and she's saving 5,000 rupees is great news. So I would again repeat the same five schemes, Rutu. Start with these five. Of course, 5,000 rupees is not large amount, but start with five schemes. Then you can keep topping up as your incomes go up. Franklin India Blue Chip, HDFC Flexi Cap, Kotak Emerging Equities, SBI Contra, and ICICI Focused Equity. All these come from five different categories. So their objectives are different, their styles of management are different, they complement each other rather than compete with each other. So that's why you have a robust five scheme, five asset management company portfolio to begin with. But one very important thing, especially to young people, I always caution them that mutual fund is going to be a goddamn boring instrument. Be prepared to that it will not give you excitement. You may open the portfolio after 1 year and realize that you're down 5%. But that's the pain it gives you in the short term for it to be rewarding enough in the long run. So with an expectation which is tapered, if you start this begin this journey, wealth creation nearly becomes a certainty. If your expectations are tapered for a mutual fund delivery, which is always going to be boring, but will go be adding little by little over long periods for you to retire rich or to help you save for other objectives which you will have at the age of 30, 40.
All right, so that will be all, and all the best, Ritu, for your investment strategies and plannings ahead. And with that, it's a wrap. Thank you so much, Firoz, for being on the show and helping our viewers invest better and make a profitable investment portfolio. And with that, it's a wrap on the show as well. And you can actually send us your queries because we pick up your queries and get our experts give you the right financial strategy for you. What you can do is just WhatsApp your number on your question on 865-797-4571. That's the WhatsApp number. Or you can email us your queries on themoneyshow@etnow.tv. So this is the place where you can reach us with your queries. Thank you so much for watching. Goodbye.